If history doesn't repeat itself, it sure does rhyme. Mark Twain. This next section for me was something that really resonated with me. We are taught that history is a straight line of events. One event leads to another, to another. This is false. It happens in waves that repeat over and over again throughout history. They generally happen over a lifespan, so you often don't see the trees from the forest. They have different sets, but we have the same actors and the same storylines. History merely repeats itself. It has all been done before. Nothing under the sun is truly new. Ecclesiastes 1:9. So here's your 4 seasons. And this is the Kondratieff Cycle. And Nikolai Kondratieff was a Russian economist during Stalin's times that saw essentially like an 80-year cycle in the economy. And it starts off with the spring cycle. There's a gradual increase in business activity and employment. Consumer confidence increases in line with growing economy. Consumer prices start a gradual increase from very low levels. Stock prices begin to steadily rise and reach the peak at an end of the spring. Interest rates rise slowly from historically low levels in line with the gradual expansion of credit. And the idea is that it's the beginning of a new cycle. So there's a fear from a terrible depression that they just came over, and there's fragile confidence that begin, just as like a baby starting to take steps and gradually start to babble those first couple words. There's that increasing confidence that things are going to be better. There's benign inflation that generally increases. There's a slow increase in credit, and the things that generally do best in this time period are stocks and real estate. So if you look at this, we can't see the other thing. The next stage is the summer. Now the summer is marked by a little bit, again, the heat. It's more confidence is built up, so there's more confidence there, and we usually see a war during this period. I don't necessarily agree with this time frame, but there was the War of 1812, the Civil War, World War I, and the Vietnam War were those summer wars that weren't all-out blowouts. I disagree with the Civil War part. But financed by massive increase in money supply that leads to a large inflation. So this is, again, what David Hackett Fisher's brought up, that people began to buy more, the price equilibrium breaks, and then governments start to become more aggressive in their finances. Gold prices reach a significant peak at the end of the summer. Interest rates rise rapidly at the peak of the summer. Stock market's under pressure and ends the summer with a bear market low. So there's growing confidence. Inflation quickens, so the commodities do better than the paper assets. There's a pace of rate increases pick up. And again, during this time period, not paper assets do well, but real estate, commodities, and precious metals tend to do best during this period. So the indication of a season change is that the stock bear market bottoms, interest rates peak, inflation price peaks, and we have a recession. Then comes autumn. A massive stock bull market is financed by fiscal and monetary largesse. Stock prices reach an euphoric peak and start the signal of winter. Inflation and commodity prices fall. Real estate prices rise, reach their peak at the beginning of winter. Gold and gold equities are in a bear market. They reach their bear market low at autumn's end. Debt reaches astronomical levels by the end of autumn. Massive consumer confidence due to stock prices, real estate prices, and plentiful jobs. So now we're past the initial crisis that was saw during the summer. Increasing confidence to extreme overconfidence to euphoria. Then finally, we have falling inflation, so it leads for great business opportunities as inflation's benign. There's a massive increase in credit, and principally to consumers that are fueling this rise in the economy. And I hope you're starting to see where all this is starting to fit into where we are. The best investments during this time, again, are now bonds, stocks, and real estate. The final cycle is the winter cycle. Stock starts a major bear market. The bear market's in proportion to the preceding bull market. So if you think about how large the bull market ran for from 1980 to 2000, it was a huge run-up. The Dow Jones was at 777 in 1982 and rose all the way to 11,750 in 2000. I think it even went to like 14,000 back in 2005. But there's a debt repudiation is significant. People start defaulting on their debt. Companies start defaulting on their debt. Municipalities, states, even governments will start to default on their debt since the money supply is no longer increasing, and that, as we know, there has to be more debt that's brought into existence to pay for the year's previous debt and interest. Banks and quasi-banks are in crisis. There's a credit crunch as interest rate rises. There's international currency crisis. Gold and gold equity rise as deflation takes hold. So now this period is marked by concern, fear, panic, and then finally despair. The falling inflation quickens to outright deflation. Following the credit crunch, virtually no credit. Rates fall and then rise into the credit crunch. And the best things to have during this time are gold, cash, bonds after the credit crunch. So let's look at during this period. And again, I don't fully agree with what's going on because I think this would be a great map of where the economy is going if we had an honest monetary system and the governments didn't have the ability to print unlimited amounts of money. So while this Kondratieff cycle is calling for a deflation, this is the first Kondratieff cycle that we have where we have worldwide fiat currencies where governments have no restraint by the gold system, by the gold price. We will see a hyperinflation that will do the same destruction in the economy, cause the same concern, fear, and panic and despair, and wipe out the old order. So, there's always a debate between deflation and inflation. Do your own research. I'm solidly in the camp of hyperinflationary depression. Things that are bought on credit will be in nominal terms will go up, but in real terms go down. But things that are usually bought with cash, such as food and energy, will go up in astronomical values. But let's go through the cycle. So June 13th, 1949, they say at the beginning of this cycle, the Dow Jones was in 161 and gold was at 35 because it was pegged at 35. The Dow Jones ran to $995. Gold was still pegged at $35 an ounce. But once it broke its peg with Nixon, during the summer period, ran from $35 to $850 in 1980, whereas the Dow Jones actually fell in value, and when you look at it, inflation was really much worse than that. So finally, the paper prices reached their bottom. Dow Jones reached its bottom in 1982. It went from 777 to 1100, and again, we saw it go a little bit higher. And we could see in the hyperinflation that it could just go to, a trillion Dow Jones, but it doesn't mean anything because the dollar doesn't become worth anything. So let's look at the bigger picture of this. During the spring and autumn period, paper assets are the assets to own. If you have stocks and bonds and real estate, because real estate is a real asset, but it's mainly financed and its market's driven by the access of credit, which is paper. And during the summer and winter months, hard assets are the outperforming. So just real simple, identify where you are and be ahead of the curve. Don't listen to the news. Don't listen to your buddies. They don't know. Stick to this cycle and it will pay off. And it's a lot easier because you don't have to watch the stock market every 5 minutes. Put it in and forget about it. You can, and it's good for almost 20 years as this cycle goes. So let's look at the same Kondratieff cycle in linear terms. We'll be able to watch stocks, interest rates, and inflation. So this is a little bit longer. This is going back to the 1700s. So we go into summer, fall, winter, spring, summer, fall, winter, spring, summer, fall, winter. You can see a lot of this stuff on longwaveanalyst.ca. That's where I got all these charts from, and it basically shows the rise of the stock markets, the price of the CRB, interest rates, and they all keep following the same general pattern. So let's look at the sunspot cycle. And again, this is my conjecture. We ended the Kondratieff fall, I believe, right around September 11th, 2001. That marked, in my mind, the end of the optimistic hubris that went on. And that we began to go into a Kondratieff winter, which could possibly last for 18 or 20 years. Now, stage one is that switch in momentum, where the system tries to keep the status quo by using old tools that worked in the past, but it can't stop the decline in economic activity and confidence in institutions. So during this period, the government used its old tried and true method of lowering interest rates. So they lowered interest rates like crazy, which sparked a real estate boom, but it was a false boom built off of incredibly low interest rates and lax lending standards that led itself to rampant speculation, and now we're feeling the effects of that. But it didn't stop the inevitable, this breaking of the economy. This next stage, which we're on the cusp of, I feel, we're going to have a violent upheaval. We're going to have systems that collapse, and this is going to be the most maximum danger period. If you look at all these, really incredibly powerful times in history, like the Civil War and World War II, and these climactic times, they usually last 2 to 3 years, and it's all of societies and human beings going at each other and really fighting for what that new order is going to be. And then finally, stage 3 of this Kondratieff winter, everything is washed away. We start to see balance that's going to be restored. Old solutions and institutions give way to new ones. And there's seeds of the recovery. It still does not feel like anything good is going to happen. And that can last for 3 to 7 or 10 years after that as we start to get better. So if you kind of look at it from a more human perspective, stage 1 is kind of drunk driving and things were okay, but the car's a little wobbly. And then finally, stage 2 happens where you lose control of the car and you go off into the ditch and you're violently tossed around and you don't know if you're going to live or die, and then finally you come to a stop and the ambulance comes and you go to the hospital and you don't know what's going to happen. And that stage 3 is you sobering up from all the mistakes from the Kondratieff fall, learning to walk again, trying to get your balance, getting things back into order, resetting your priorities. And that's what we do as a society. We start to figure out what kind of life do we want to live now. So start thinking in terms of these cycles, and that they're really predictable if you can kind of put some thought to it. So here's the spring. Here comes the summer. Then things start getting really bad, and then it's just washed away. And this is what the Kondratieff winter is going to look like towards the end, where everything's just washed away, and where do you pick up again? So actually, I think this is the fall. This is stage 1 of the Kondratieff winter. Stage 2 is that violent period that we're looking at anywhere between now and 2013, but it looks like 2012 is when all this is really going to hit. And then afterwards, this is the pieces are going to be picked up. People's lives are going to be devastated. Everything that they believed in was gone, and they have to start all over again. This larger force is what brings an end to bull markets, companies, governments, ideas, institutions. We're in the middle of the most dangerous part of this change, where the regime that's in power tries to use all of its power to fight against what is inevitable. People will no longer react to authority because their mood has changed. The regime looks ineffective. Old lies die. New truths become self-evident.